I'm going through real property investors' mistakes to show you what can go wrong with an investment property, and through this, you're going to learn how to avoid property investment disaster. Our first nightmare comes from an investor, Brandon, who's recently moved to Queenstown and has rented out his own home in Auckland. And the issue is he is bleeding cash. That's because while interest rates are really high, the rent coming in from the tenant isn't covering all of the costs. Now, some of that is normal in today's market, but the issue is that the cash flow is way worse than what Brandon is comfortable with. If we head into the comments section, we can see that his mortgage is about $5,400 a month, but the rent is only $3,250. So that means before he pays his rates, his insurance, his maintenance, his property management, he's already down about $500 a week. So the first step is to run a cash flow analysis. Now, I don't have his exact numbers, but I can make some estimates. Based on that repayment amount, I think his mortgage is probably about $725,000. It's probably on principal and interest since it was his own home. His interest rate might be 6.5%, ballpark. On top of that, I've included all of the usual estimates about costs would include in a property. And I do have a 15-year cash flow forecast, but for today, I'm going to keep it really simple. At the moment, he's got about $38,000 worth of rent coming in. Total costs would be about $76,000. Now that means that the real cash flow shortfall is about $39,000 a year or $750 a week. So the first mistake that Brandon probably made was not running a cash flow analysis. But if he had done that, he would see that he's currently paying back the bank about $18,000 a year in principal repayments. That's to pay down the loan. Again, very normal if it's your own home and you're living in it, but a bit more unusual if it's an investment property. So one thing Brandon could do is talk to a mortgage advisor and see if he could put that mortgage on interest only. Now, if we do that, see the impact it has on the cash flow. Now he's only down $400 a week, which is more usual for what we'd expect for a property in today's market. The other thing he could do is talk to a mortgage advisor, see if he can get a lower interest rate. But if you want to avoid the same mistakes as Brandon here, first thing you could do is don't turn your own home into a rental property. It often leads to lower rental returns. The second thing is make sure you run the cash flow analysis, because having done that, you might have thought, you know what, before I move off to Queenstown, I need to sell this property in Auckland first. And the third thing is talk to a mortgage advisor, especially when you turn your own home into a rental property, to see how you can restructure that mortgage. Next is an investor in a really tough position. He's signed up to buy 2 townhouses in Wellington, but now that these townhouses are built, the bank said they're only able to give him the money for one. Now, this is a bit of a risk when you buy a new build off the plans, because you might sign the contract to buy one, but that property is going to take 18 months to get built. Now, the issue is that banks will usually only give pre-approval for your finance for 3 to 12 months. So it's quite usual to go unconditional on a property, but not having the finance totally in place. That is a risk of buying a new build, but that also comes with the benefits of buying that new build. Now, he said, what are his 3 options? He can either sell one property at a loss to buy the other. He could go back to the developer and lose his 10% deposit that he's already paid down, or should he approach any non-bank lenders? Now, the issue with the first 2 options is if you try and sell one of these properties at a loss, he's probably going to lose quite a bit of money. At the moment, there are about 6,500 new build properties on Trade Me that people are trying to sell, and developers are highly motivated because the market's quiet and so are discounting prices. On top of that, there's probably a clause in his contract that says he's not even able to sell that property depending on who the developer is. So I don't see that as an option. The other issue is if he goes to the developer and says, hey, look, I can't get the money to buy this property, then depending on the purchase price, he is going to lose his 10% deposit, perhaps up to $50,000 to $100,000. So the best option is to talk to other lenders to try and get the money to settle on this property. Now, if he's struggling on the deposit side, he could potentially go and talk to TSB. They are willing to lend on properties and don't require a valuation if you've used a real estate agent. But if he's struggling on the income side or servicing side, he could go and talk to a non-bank lender like Resimac or Liberty. These guys usually have a bit looser criteria. But if you want to avoid the same situation as our investor here, the first thing to do is to try and get your pre-approval done as far out in advance as possible. Most banks will go up to 12 months, but some, like Westpac, will go up to 24. For our last investor, something went horribly wrong. And if you want to avoid the same mistake, you've got to subscribe to our YouTube channel because we release new videos every Monday and Wednesday. And if you've been subscribed for a while, it probably won't surprise you that this investor purchased an existing property which often comes with maintenance issues. But what this investor didn't expect is that after a couple of days of buying that, the roof started leaking. Now, here's the issue. They got a building report from the previous owner and nothing was mentioned in the report. Now, the mistake this investor made was relying on a building report that was provided by the person selling them the property, the vendor. And the issue is that if you get a building inspection report and your name is not listed as the client, then the building inspecting company owes you nothing. You're not their client, you have no recourse to challenge them or say that they did something wrong. Now, this investor could potentially go back to the vendor, the person who sold them the property, and say, well, you didn't disclose to me this issue and you knew about it. But then you've got to prove that that person actually did know about the leak, did know about the issue. So what do you do if you want to avoid this mistake? Well, the first thing you could do is get your own building inspector's report when you're purchasing a property, especially an existing property. The second thing you could potentially do, though, wouldn't recommend it as much, is that if you get a building inspector's report provided by the person selling you the property, go back to the building inspecting company and get them to put the document in your name. That means you're now their client, and if they've done a bad job, you can go back and challenge them on the report. But if you really want to avoid maintenance issues, one thing you could potentially do is invest in new build properties because everything's brand new. They are going to be lower maintenance. And if you want to learn more about that, head over to opuspartners.co.nz because we help regular Kiwis build their wealth by investing in new build properties.